Imagine using a dollar stablecoin that was not issued by a bank, not created by a company balance sheet, and not backed by someone simply promising to behave. That is the puzzle Maker tried to solve, and it is why MKR became one of the most discussed tokens in DeFi. Crypto is volatile. Bitcoin can move sharply. Ether can move sharply. But many crypto users still need something dollar-like for trading, lending, payments, and accounting. Maker was built around a simple idea. Let people lock valuable assets in smart contracts and generate a stablecoin against them. Maker is best understood as a decentralized credit system. Users put collateral into vaults. The protocol lets them create DAI against that collateral. Governance decides what collateral is accepted, how risky each type is, and what fees or limits apply. A simple crypto app might let you swap one token for another. Maker is different. It is closer to a financial machine made of smart contracts, auctions, price feeds, risk settings, and voters. The user interface may look simple, but under the hood, there is a full monetary system. DAI was designed to track the value of one United States dollar, but instead of every DAI being a claim on dollars in a bank account, DAI is created through debt positions. A user locks collateral, borrows DAI, and later repays DAI to unlock the collateral. Picture someone locking Ether in a Maker vault. They do not sell the Ether, they use it as collateral. The vault then allows them to generate DAI, up to a limit. If they repay the DAI plus required fees, they can close the position and withdraw the collateral. The key word is over-collateralized. Maker does not usually let a user borrow $1 of DAI against exactly $1 of collateral. The system requires a cushion. That cushion exists because crypto prices can fall quickly, and the protocol needs time to protect DAI holders. If the collateral value drops too far, the vault can become unsafe. Maker cannot politely wait forever and hope prices recover. The protocol may liquidate the vault, sell collateral through an auction process, and use the proceeds to cover the DAI debt. This is the invisible promise behind DAI. The protocol is trying to make sure every DAI is backed by enough value somewhere inside the system. The backing is not just sitting in one pile. It is spread across vaults, accepted collateral types, reserves, and stabilization tools. A stablecoin peg is not magic. It is maintained by incentives. If DAI trades above or below its target, users, arbitrageurs, and protocol settings can push it back toward balance. Maker governance can adjust rates, collateral limits, and other parameters when the system needs pressure changed. When someone generates DAI from a vault, they are not getting free money. The debt can accumulate a stability fee. You can think of it as the cost of borrowing from the protocol. Governance can raise or lower these fees based on risk, demand, and peg conditions. If explanations like this help make DeFi feel less mysterious, consider subscribing. We focus on how these systems actually work, without price predictions or hype. Now, let us go one layer deeper, because Maker is really a story about governance as much as stablecoins. MKR was the original governance token of Maker. Holding MKR did not mean owning DAI. It meant having a role in decisions about the protocol. MKR voters could approve changes such as new collateral types, debt ceilings, liquidation settings, and fee adjustments. Maker governance is not just symbolic. If voters approve weak collateral or bad risk settings, the system can become fragile. If they are too conservative, DAI supply may be limited, and borrowing may become unattractive. Governance is the steering wheel, but it also carries responsibility. In Maker, governance changes are often packaged as executable code. A proposal can change real numbers inside the protocol. That might include a fee, a debt limit, or a collateral parameter. This is very different from a poll that only expresses an opinion. MKR also had a deeper role in the old design. If the protocol suffered a major shortfall after collateral sales, MKR could be diluted to recapitalize the system. That made governance token holders connected to system risk. Good decisions mattered because bad decisions could affect them too. When the system earned more than it needed for expenses and reserves, Maker historically used mechanisms connected to surplus and token supply. The details changed over time, but the principle was clear. Governance tokens were tied to the health of the protocol, not just to a logo. Bitcoin is mainly a fixed supply asset and payment network. Maker is almost the opposite kind of system. It is adjustable by design. It changes collateral rules, fees, and risk limits. That flexibility helps it respond to markets, but it also introduces governance risk. Ethereum is the base platform where many smart contracts run. Maker is one of the financial systems built on top of that kind of platform. Ethereum provides the general purpose rails. Maker uses those rails to create vaults, DAI, auctions, and governance-controlled monetary rules. Fast chains and trading apps often focus on speed, low fees, and user experience. Maker's core value is different. It is about collateral management and decentralized stablecoin design. Speed matters, but the harder question is whether the system stays solvent during stress. Maker started with a narrower design, where Ether was the main collateral. Later, the protocol moved into multi-collateral Dai, which allowed governance-approved assets beyond just Ether. That change made the system more flexible, but it also made risk management more complicated. Not every asset is safe in the same way. Ether has deep markets, but can be volatile. Stablecoins may be less volatile, but bring issuer and censorship risk. Real-world asset exposure can bring yield and diversification, but also legal and operational complexity. To know whether a vault is safe, Maker needs prices. Those prices come from Oracle systems. If the price data is delayed, manipulated, or unavailable, the protocol can make bad decisions. Oracles are one of the most important hidden dependencies in any collateralized stablecoin system. When a vault is liquidated, the collateral needs buyers. In calm markets, auctions can work smoothly. In stressed markets, liquidity can vanish, gas fees can spike, and prices can move faster than the system expects. This is where stablecoin design meets real market chaos. Maker also developed tools that help Dai trade close to its target. One important idea is a peg stability module, which lets users swap between Dai or related stablecoins and other approved stablecoins under defined rules. This can make the peg easier to defend, but it can increase dependence on centralized collateral. This is one of Maker's biggest tensions. A purely crypto-backed Dai may feel more decentralized, but it can be hard to scale and expensive to borrow. Adding stablecoins or real-world assets can improve liquidity and revenue, but it brings outside dependencies into the system. Maker has different users. Some people simply hold or use Dai. Some open vaults to borrow Dai. Some provide liquidity. Some vote in governance. These groups do not always want the same thing. So the protocol has to balance stability, growth, risk, and usability. A common misunderstanding is thinking MKR and Dai are two versions of the same asset. They are not. Dai is the stablecoin users spend, borrow, or hold. MKR was the governance and risk token. One aimed for dollar stability, the other carried protocol decision power and market risk. MakerDAO has been transitioning toward a broader identity called Sky. In that transition, Dai and MKR gained upgrade paths to newer Sky ecosystem tokens. Dai can convert one-to-one with USDS, and MKR has a conversion path into Sky, the newer governance token. The Sky transition can be confusing because names change faster than mental models. The basic idea still comes from Maker's history. A stablecoin system needs collateral, rules, governance, risk controls, and incentives. The labels may evolve, but those mechanisms remain the part beginners should understand first. In the Sky upgrade path, MKR can convert into Sky at a fixed protocol ratio. The important beginner takeaway is not the number itself. It is that governance power is moving from the older MKR identity toward the newer Sky identity as the ecosystem evolves. Dai also has a related upgrade path to USDS. For many users, Dai remains familiar because it has years of integrations across DeFi. USDS represents the newer Sky stablecoin direction. The key is to avoid assuming every wallet, exchange, or app treats the transition the same way. People still talk about Maker because it helped prove that stablecoins could be created by smart contracts and collateral, not only by bank deposits. It became a base layer for lending, trading, treasury management, and DeFi experiments. Its history is part of DeFi's history. Maker is not risk-free. Vault users can be liquidated. Dai or USDS can trade away from the target during stress. Governance can make mistakes. Collateral can fail. Smart contracts can have bugs. Bridges, front ends, and integrations can add their own separate risks. So what is Maker without the hype? It is a decentralized stablecoin and credit system built around collateralized vaults, risk parameters, auctions, and token governance. MKR was the original governance token, and the ecosystem is moving towards Sky and Sky. The value of understanding it is mechanical, not promotional. If this still feels complex, that is normal. Maker is not one product. It is a living financial protocol with many moving parts. Drop your questions in the comments, especially the part that confused you most, and suggest the next crypto system you want explained without the hype.